Okay, so once again, welcome to this discussion for receivable financing. For this discussion, our focus points is to discuss the basic concepts of receivable financing. Then, ano ba yan? Saan na to? Ulit, focus points natin is to discuss the basic concepts of receivable financing. Then differentiate the types of receivable financing schemes or receivable financing tools. Then, along the discussion, we discuss sample problems. So let's start with receivable financing for the basic concepts. Receivable financing is defined as a financial scheme. Other books have it as financial capability. So financial scheme used by a company for purposes of raising additional cash inflows with the use of its existing receivables. The reason for engaging or resorting to receivable financing in order to raise additional cash inflows is for the company to cope up with its financial liquidity and solvency. However, in actual practice, particularly in the financial management aspect, entities have different uh, tools or schemes of financing. They could either engage in long-term financing, like borrowing funds from the bank, borrowing funds from the bank, like if they are financing a long-term project or business expansion or whatever. But if we are focusing on other types of financing, we can include the receivable financing, which could be part of um, management's way of coping with its operations, particularly on liquidity and solvency. For this purpose, how do we define liquidity and solvency? Liquidity is defined as the company's state or ability to settle its currently maturing obligations. So for liquidity, we are focused on the current portion of the liabilities. Liquidity is referring on the short-term or short-run perspective. While solvency on the other hand is the company's state or ability to cope up with its long-term obligations. Both liquidity and solvency has something to do with the company's um, uh, has something to do with companies. Wait, I forgot the term. Mm, yun. Liquidity and solvency both have something to do with the company's ability to cope up with all of its obligations. The only difference is that liquidity is short-term and solvency is long-term. So we are referring for liquidity for the obligations that are currently maturing or those obligations that are to be paid within the short period of time. While solvency is referring to the long-term perspective. It is actually referring to the uh, continuous financing perspective of an entity. So for liquidity, we can say for short-term obligations or current liabilities, then solvency is referring to long-term obligations or long-term liabilities. So receivable financing could be one of the scheme that an entity could use or to resort to when coping up with these two, liquidity and solvency. Again, receivable financing means it is a financial scheme or a financial capability of an entity to use existing receivables to raise additional cash inflows. There are 4 types of receivable financing scheme that an entity could resort to. We have pledging, assignment, factoring, and discounting. The first 3, pledging, assignment, and factoring, refers to accounts receivable, and the discounting refers to usually to notes receivable. Then the question would be, why is it that among the different types of receivable, we made only mention of accounts receivable and notes receivable? The reason for this is that accounts receivable and notes receivable are the most common types of receivable that an entity may engage into. So, although we refer notes receivable in our previous discussion as could either be trade or non-trade, current or non-current, along with accounts receivable, an entity engage it in somewhat regular basis. So it is more common, especially in the trading activities. So we have accounts receivable and notes receivable. So how do we differentiate the 4 types of receivable financing? By the way, if you can still follow, kindly raise hand. Okay. So to differentiate the 4 types of receivable financing, let's start with pledging. Pledging involves serving all of accounts receivable of a company as collateral or security for loans and other borrowings. Pledging is actually general as to serving of accounts receivable or receivables. Now, when we say general, it does not regard to whom the entity has a receivable. As long as there is an accounts receivable, then it could be set aside or pledged as collateral or security for a loan or any other types of borrowing. So take note that pledging is general type of borrowing, general type of financing when it comes to borrowing, since it serves all. Take note, all. Because of all, it is termed as general. Okay? General. So in this illustration, uh, for pledging, when a company asks for a loan and serves all of its accounts receivable to as collateral for the loan, for example, the company made arrangements with the bank. The company serves the accounts receivable, but that doesn't mean that the company is giving out already the accounts receivable. The bank extends the loan, but the involvement of the accounts receivable does not mean there's a transfer of ownership. The loan, the accounts receivable is just being served as collateral. What does it mean? Provided that an entity commit default on payment, the resort of the bank is to tawag nun, the resort is to ask payment through collections of those accounts receivable. So for example, in a normal loan arrangements with the bank will ask for security. For example, normal security that the bank asks is, are properties like land, building, and other chattel mortgages. So we have real properties, real mortgages, then we have chattel mortgages. When the bank extends the loan, it is the obligation of the borrower to pay the loan through cash. Now, in case the borrowing company or the borrowing entity fail to pay the amount of loan through cash in every maturity date, then the bank will resort to foreclosure of those properties. So for example, sa inyo na lang, when uh, when you ask a loan from the bank will usually ask you for what security you're going to lend to the bank as security for the loan. Usually you will sa contract you will have it sige, yung bahay ko na lang yung gagawin kong security. Or yung mga properties ko gagawin kong security. Or portion of my inherited land, yun yung gagawin kong security for my loan. Now, it doesn't mean na immediately the bank will get the land or the property as payment. The bank will continue receiving payments from you, and the bank will only resort to foreclosure or getting the property as payment in case you defaulted for payment. So for example, the agreement is to pay every December 31 of each year, and you already have failed payment for, let's say, 3 consecutive December 31 payments. So meaning every year payment, you've already failed 3-year payments. That means the bank will resort to foreclosure of the property. However, in pledging, sometimes it is part of the agreement that no matter in case there is collection on that pledge accounts receivable, the bank may ask payment out of those collection, but it depends on the agreement. Okay? The company still have to pay through cash, and in case of default, then the bank will resort on the pledged accounts receivable. So any collections of that out of that accounts receivable will be served as payment of the loan in case of the default. Okay? So under pledging, there is no transfer of ownership over the receivables at the date of transaction. The only requirement for pledging is to disclose that all the receivables of the entity has been pledged as security. No journal entry, no journal entry required for pledging other than the recording of the loan. So when we classify our receivables, the items of receivables that have been pledged, it does not require any journal entry, rather disclosures only, the notes to financial statements. So after when we are making financial statements, we're going to disclose in the notes to financial statements that all of our accounts receivable have been pledged. So yun lang yung requirements sa pledging. By that sense, the total assets and total receivables remain unchanged per balance at transaction date. The only thing that could decrease the receivables is collection, credit memo, and write-off. Yun lang. Other than that, mere pledging will not decrease. Again, pag pledging, no transfer of ownership yet. Okay, no transfer. Meaning, the borrowing company still have the ownership over that accounts receivables. So take note of these key points. So let us have this example. Beluga Company borrowed 2 million from Cash Cow Bank and signed a contract of loan with the bank as evidence of borrowing on January 1, 2020. The bank extended the loan, less 10% interest deducted in advance, and is payable on January 1, 2022. The entity pledged all its accounts receivable totaling 2,500,000 as security for the loan. Any collections of accounts will be used as payment of the loan until fully paid. The company was able to collect accounts receivable 500,000 July 1 and another 500,000 on December 30 of 2020. So our requirements, the net cash proceed, the balance of loans payable, and the balance of accounts receivable. Take note, in the problem, it is provided that the loan has been extended with 10% interest deducted in advance. Meaning the corresponding cash proceed that we're going to receive from the loan is already 10% less. Okay, 10% less. The deducted interest in advance will be treated as a discount. We're not going to pay any more interest through cash, but um, we're going to recognize interest in the form of amortization. Okay. The loan is also payable on January 1, 2022, meaning the loan has a life of 2 years. So from January 1, 2020 to January 1, 2022 is approximately 2 years. Then the entity pledged all its accounts receivable totaling 2,500,000 as security for the loan, meaning in case of default, the the bank could resort uh, payments out of the accounts receivable, out of the collections on the accounts receivable. Yan. So there was an agreement that any collection of accounts receivable will be used as payment of the loan until fully paid. The lending company and the borrowing company may not agree on this one. But because of observing 2,500,000 as security, they may agree on this one, that the collections of those pledged accounts will be made as payment of the loan until fully paid. Okay, so how do we solve the requirements? So January 1, 2020, the face value of the loan, which is 2 million, less interest, which will be treated as a discount. So 2 million times 10% will be 200,000. Gross cash proceeds will be 1,800,000. Then deduct service charges and other expenses, should there be any, provided the problem. But since the problem did not provide for information of service charges and other expenses related to the loan, we assume 0. So net cash proceeds will be 1,800,000. So as of January 1, 2020, our net cash proceeds will be 1,800,000. Then our journal entries to debit cash, 1,800,000. Debit discount on loans payable, 200,000, the interest deducted in advance. Then credit loans payable for 2 million. Now, in order for us to recognize interest later on, this discount of 200,000 will be amortized through simple amortization by use of straight line method. Okay? That's why I've emphasized the life of the loan, which is approximately 2 years. Okay. So for interest, expense, or amortization, we divide 200,000 discount by 2, since we are referring to 2-year life of the
Nagaya ka ba man, sir?
2-year
Nagaya
life
ka
of the
sir.
loan. Annually, we're supposed to recognize 100,000 amortization out of the 200,000. But because the collections of 500,000 happened every after 6 months of 2020, it is only proper to
Ano?
recognize 50,000 or half of the annual amortization right after the payment of the loan
Ito ay pag-restarting.
on
Oo.
July 1 and December 31, December 30.
Hindi talaga diya.
Okay, that should be 50,000. We go back with the problem. The company was able to collect accounts receivable of 500,000 on July 1 and 500,000 December 30. Then any collection will be used as payment. So for July 1, we debit cash and credit accounts receivable for the amount of 500,000. Since any collections will be applied as payment for the loan, we debit loans payable and credit cash for the same amount of 500,000. Then we recognize interest expense by debiting interest expense and credit discount on loans payable,
Okay.
50,000. Next, for December 30. For December 30, the same amount, we debit cash and credit accounts receivable, 500,000. Then apply it also as payment with debit loans payable and credit cash for 500,000. Then last, the interest expense for the year. Second amortization, we debit interest expense and credit discount on loans payable, 50,000. So not much of a complicated accounting procedures for pledging. So yan, sundan lang yung story ng problem on how to account for the pledging transactions. So kindly raise hand if able to catch up. Next, we move forward with assignment. So for assignment, it involves serving specific accounts receivable as collateral or security for loans and other borrowings. In contrast with pledging earlier, pledging is general because it serves all of its receivables or accounts receivable. But for assignment, it's very much specific. When we say specific, selected accounts receivable will be served as collateral for a loan or a borrowing. Okay, so that's the difference with assignment and with pledging. Assignment is actually a form of pledge, but assignment is differently accounted with pledge because assignment only serve specific accounts receivable. To be specific, those accounts receivable pass the so-called quality check, meaning if the accounts receivable are in good qualities or the accounts receivable have high percentage of collection. So in case the accounts receivable has already been long outstanding, then already have doubt for collections, then those accounts receivable will no longer be considered part of serving as collateral or security. So the same with pledging. There's no transfer of ownership over the receivables at the date of transaction. Although there is a journal entry required already for the assignment of accounts receivable. For pledging, if it is only required to disclose in the notes to financial statement, but in assignment, we are required to prepare a journal entry to separate accounts receivable, the assignment of accounts receivable from those accounts that are unassigned. By that, the total assets and total receivables remain unchanged in balance. Then receivables are only decreased through the collections, credit memos, and write-off. Assignment could either be under non-notification basis or notification basis. How do we determine if assignment is under non-notification basis or notification basis? What does it mean by notification basis? What does it mean by non-notification basis? So for non-notification basis, the illustration is when a company or a borrowing company asks for a loan, it serves a specific accounts receivable as collateral to, for example, to a bank. Okay? The bank then extends the loan to the borrowing entity. Now, as to payment, what happens if it is non-notification basis? By the name itself, the distinguishing feature is that customers are not notified by the company that their specific accounts have been served as collateral for the loan. Therefore, the customers will continue their payment to the borrowing company. Then the borrowing company will make payments to the bank in order to settle the loan. The agreement mostly to apply the payments of the customers or the collections from the customers as payment of the loan. Yun yung notification basis. The distinguishing feature customers are not notified. So therefore, the customers will still pay to the borrowing company. Okay? So again, the distinguishing feature or the concepts applied or the important points for non-notification basis, customers are not notified, so they continue pay their accounts to the borrowing company. And the company pays the bank the amount of loan until fully paid. For notification basis, ganito naman yung scenario. For notification basis, the distinguishing feature is that the borrowing company notifies the customers of the assignment of their accounts. By that effect, for purposes of payment, instead of the customers paying directly to the company, the borrowing company, the customers will do direct payments now to the bank. Then the bank, in return, will notify the borrowing company that there were collections from the customers. Then those collections will be applied by the bank as payment of the loan. Okay, until the loan is fully paid. Then upon full payment of the loan, any excess collections from the customers will be returned from the borrowing company. Reason because the bank or the lending company is only entitled for the amount of loan, including interest. But any excess of the collections over the amount of loans paid will be returned to the company. The reason for the bank notifying the borrowing company for any collections from the customers is for the company to be aware of the collections and in order for the company to have adjustments for the records. Okay? In order also for the company to track down of how much of the assigned accounts receivable had been collected. Okay? So kindly raise hand if able to catch up between the difference of the two. Okay, so for notification basis, customers are notified of the assignment. Therefore, they pay their accounts to the bank or to the lending company directly. Then the bank notifies the company for the collections. Then the collections will be applied as payment of the loan until fully paid. Then any excess will be remitted or returned to the borrowing company. The question now is, sir, what if? What if the assigned accounts receivable is not sufficient to cover the amount of loan? So if the assigned accounts receivable is not sufficient to cover the amount of loan, what will the company do is to assign again. To assign again other accounts receivable to the customers. Then do the same thing. Upon assignment, the company will notify the customers of the assigned accounts. The same goes with non-notification basis. If the accounts receivable are not sufficient to cover the loan, the company will reassign another account receivable. But in contrast with notification basis, they will not notify the customers. Yun lang yung difference. Take note. The difference of the two bases. Okay? How do we consider assignment if it is notification basis? Check if the customers are notified. If not, then consider the assignment as under non-notification basis. So let us have this example. Castle Company assigned 1,800,000 of accounts receivable to 10th Bank on January 1, 2019. The terms are 90% of the accounts for the loan, less 25,000 service charge as cash advancement. Meaning 90% of 1,800,000 will serve as net cash proceed after considering 25,000 service charge. The company signed a contract of loan and the loan is payable in 1 year with monthly interest of 1% based on the unpaid balance. So therefore, our annual interest is 12%. 1% times 12 months, that would be 12%. Collections from assigned accounts as payments to the principal amount of the loan plus interest on unpaid balance. Meaning, any collections of on the assigned accounts will be applied only to the principal amount, then the interest will be paid separately. Be careful of that information on problem solving, because sometimes problem solving will provide that collections will be made first as payment of the interest, then any excess of the collection will be applied to the principal amount of the loan. There are some problems that provide for that agreement. But nonetheless, we proceed. We have we've been provided with 3 transactions. Transaction on January 30, company was able to collect 237,500 worth of cash after corresponding 5% cash discount offered for prompt payment. Our clue here, our assumption here is non-notification basis. Reason for being non-notification basis because of the statement the company was able to collect. So therefore, it is the company, Castle Company is still the one receiving payments from customers. Take note, under non-notification basis, the company does not notify the customers of the assignment. So the effect, the customers will continue paying to the company, the borrowing company. Then later on that day, the collections were remitted to 10th Bank as partial payment of the loan plus interest. Take note that the 237,500 is the worth of cash received after corresponding cash discount. It is not the amount of accounts receivable to be credited. Rather, it is the amount of cash to be debited. Then on February 28, 25,000 worth of merchandise sold were returned. The return was related to assigned accounts. Be careful on returns because sometimes returns are referring to unassigned accounts receivable. So if the accounts receivable, if the sales return does not pertain to assigned accounts, then we can ignore number 2. But because the return related to assigned accounts, then we account that return charged to the assigned accounts. Then on December 31, the company was able to collect 550,000 worth of assigned customer accounts. Take note, these are different now. Worth of assigned customers accounts, meaning the gross amount. Here, it is the worth, the amount of cash. 237,000 worth of cash. Here, 550,000 worth of assigned customers accounts. So we can say that this 550,000 will be the amount to be credited to accounts receivable. But in contrast with January 30, we don't have cash discount. Okay? The same thing, later in that day, collections were remitted to 10th Bank as partial payment. So requirements, prepare journal entries to record transaction on January 1, 2019. Okay? Of course, for valid references, we can apply make preparation of journal entries for transactions 1 to 3. The number 2, we have the net cash proceeds. Number 3, assigned accounts receivable balance. Number 4, loans payable balance. And for number 5, the equity on assigned accounts. So to solve, can you still read the figures and the words? Nababasa pa, guys?
Yes, sir.
Yes, sir.
Okay. So our assumption again is non-notification basis. So the face value of the loan, which will be 1,800,000 times 90%, 1,620,000, deduct service charges of 25,000, then the net cash proceeds will be 1,595,000. To separate the accounts receivable subject for assignment, we debit accounts receivable dash assigned, then credit accounts receivable. Again, by that journal entry, by this journal entry, it doesn't mean that the accounts receivable or the total receivables or the total assets of the borrowing company decreased because of that entry. Okay, it merely tawag nun, assigned or signify the portion of accounts receivable that had been assigned. Okay? But that doesn't mean there's a decrease in the assets. Then to recognize the loan, we debit cash and credit loans payable. Cash is debited to 1,595,000. Loans payable is credited to 1,620,000 face value. Then the difference is debited to the amount of service charge incurred of 25,000. So those are our journal entries for January 1. If we are referring to pledging, we don't have a journal entry to separate the accounts receivable pledge, only disclosures. But since we are in assignment, we have a journal entry, debit accounts receivable assigned and credit accounts receivable. Then for January 30, we have collected 237,500 cash after corresponding 5% cash discount. So if cash discount is represented by 5%, that would mean that the 237,500 is the 95%. Then the credit to accounts receivable, which is the base amount, will be the 100%. So therefore, 237,500 will be debited to cash, which is equivalent to 95%. We don't have any information with the cash discount other than the 5%. So 237,500, gross it up, that would be 250,000. Then from 250,000, we multiply 5%, the resulting figure is 12,500. Or simply deduct 237,500 from 250,000, still amounting to the 12,500 cash discount. And to apply the collections as payment, partial payment of the loan, so we debit loans payable for the entire amount of 237,500. Then we debit interest expense, then we credit cash. Our interest expense is 16,200. How did we arrive 16,200? Take note that the interest is on a monthly basis. So therefore, face value of the loan of 1,620,000 multiplied by monthly interest rate of 1%. Our interest for January is amounting to 16,200. So we consider January as full month, even though payment happened on January 30. Okay, so we assume full month. That's why we have 16,200. Then credit to cash, the total of 253,700. 253,700. Or if you want to complicate everything, as I have told you earlier, our annual interest rate is 12%. So 1% times 12 months, that will be 12%. You can have it as face value of the loan, 1,620,000, multiplied by annual interest rate of 12%, then multiplied by the months covered. So 1,620,000 times times 12%, then times 1/12. 12. We can still arrive with 16,200. Then for February 28, sales return, which is related to assigned accounts. Our entry is to debit sales returns and credit accounts receivable assigned. We can do this journal entry. We can have this journal entry, or if we have initially set up an allowance for sales return by debiting sales return and allowance for sales return, the effect of the return would result to a debit to allowance for sales return and credit to accounts receivable. Either way, it's okay as long as we can took effect the return and remove the related accounts receivable assigned from the records. Okay? So we can cut the process. There is a credit here of sales of allowance, then there is a debit here of allowance. So we can eliminate that one or cancel out. We can still have debit to sales return and credit to accounts receivable assigned. By the way, can you still catch up? Any questions so far? Kindly raise hand kung meron kayong questions. Or kung wala, kindly raise hand if able to catch up. Okay. Then last we have, by the way, it should have been December 31, not December 30. So for December 30, December 31, the company able to collect 550,000 worth of customers assigned accounts. So therefore, that would be a credit to accounts receivable. But since we don't have any cash discount to be applied, therefore the debit to cash is still 550,000. The same amount will be debited to loans payable, 550,000. Then we debit interest expense, then we credit cash. Our interest expense is amounting to 152,075. How's that possible? How did you arrive 152,075? Because as of January 30, our interest is 16,200. Then it bulked up to 152,075. How does this possible? Face value of the loan of 1,620,000, less payment in January, which is a debit to loans payable here of 237,500. So our unpaid balance is 1,032,500. The company actually has the option to pay interest out of based on the 1,382,500 on a monthly basis until December 30 or December 31. Okay? Or the company liwat have the option to accrue all the interest from February down to December 31 until another payment has been made. So pwede din yun. The company has that option. So, unpaid balance of 1,382,500 multiplied by the monthly interest of 1% supposed to be after January 30 or starting the month of February, we're going to pay a monthly basis of 13,825 interest based on the unpaid balance. Okay? But since we can have it as accrued, then paid until the next payment of loans payable, we can have it totaled to 152,075 by multiplying the 13,825 by the number of months covered. from February to December 31. So that is 11 months. Okay? Then credit cash to 702,007. Okay? Now, the question would be, sir, what if the collection will be applied as payment of interest first and the excess collection will be made payment to the principal amount of the loan? If that is the case, then our credit to cash, for example, on January 30, our credit to cash will not be 253,700. Example, this 237,500 is the credit to, if this 237,500 will be applied as payment to principal and interest, then the credit to cash will be the 237,500. Then versus the 16,200 monthly interest, our debit to loans payable will be the excess amount only. But because the problem provides that collections will be applied as payment of the principal amount of the loan, then plus interest, meaning interest will be paid separately. That would mean that interest is not covered by the cash collection. Okay? This debited to cash of 237,500 will be applied in full to the principal amount of the loans payable. The same goes with December 31. Okay? The same concept. But since the problem provides for separate payment of interest, then our credit to cash is both payment of loans payable and separate payment for the interest expense. That's why it is 253,700. Okay? So I guess we could stop temporarily here. So tomorrow or next meeting, we're going to continue on assignment for notification basis. Stop lang muna tayo.